So picture this. You've taken out a massive loan to build a brand new factory. The bank's charging you interest, obviously, and common sense tells you, hey, interest is an expense, so you just dump the whole amount into the profit and loss account. Simple. But what if I told you that in your CA inter exam, doing just that could cost you the entire question? This is one of the biggest traps students fall into, and today we're going to make sure you're not one of them.
Okay, let's jump right in with a classic exam-style problem. Take a look at this. PRM Limited takes a loan for 120 lakhs. They use it for 4 different things: building a shed, buying machinery, for working capital, and an advance for a truck. The total interest for the year comes out to 18 lakhs. So, the big question, the one your marks depend on, is this. Does all of that 18 lakhs hit the P&L, or does some of it get tacked onto the cost of the shed or the machinery? This is the core puzzle we need to solve. And the key to unlocking this puzzle, well, that's Accounting Standard 16, borrowing costs. The standard is all about telling us the right way to account for interest and other similar costs. Our mission today is to absolutely master it so you can ace it in your exams.
Let's kick things off with the absolute foundation of AS16. This is the core rule that everything else is built on. Honestly, the entire standard really boils down to this one decision, this golden rule. The very first question you have to ask yourself in any problem is, what was this loan used for? Was it to acquire, construct, or produce something called a qualifying asset? If the answer is yes, you capitalize the interest, which is just a fancy way of saying you add it to the cost of the asset on your balance sheet. If the answer is no, then you do what you'd normally expect. Treat it as an expense and charge it straight to the P&L. This split is the crucial first step in every single AS16 problem. Get this wrong and the whole thing goes sideways. So that immediately brings up a couple of obvious questions, right? What exactly counts as a borrowing cost, and what on earth is a qualifying asset? Let's get those definitions down pat. First up, borrowing costs. The official definition is pretty broad. It's not just interest. It's interest and other costs that you incur when you borrow funds. Now this is where it gets interesting. Of course, regular interest and commitment charges are in, no surprise there. So is the amortization of things like discounts or premiums on borrowings, and any extra costs like processing fees. Even finance lease charges from AS19 make the list. But hang on, look at that last one, exchange differences. Circle this, highlight it, put a star next to it. This is a classic ICAI playground. We're not talking about all exchange differences, but a very specific part of them can be treated as a borrowing cost. We'll come back to this, but just know this is an area where marks are often lost. Next, the star of the show, the qualifying asset. The definition has one key phrase you absolutely must burn into your memory: substantial period of time. It's not just any old asset, it's an asset that takes a good long while to get ready. So what does substantial actually mean in exam terms? Well, ICAI gives us a handy rule of thumb. Think 12 months. But, and this is super important, it's what we call a rebuttable presumption. That just means 12 months is the default, but you can argue against it if the facts of the case scream otherwise. This little bit of judgment is a classic ICAI move in their questions. And this table lays it out perfectly. Things like property, plant, and equipment, like a factory, or intangible assets being developed, or investment properties being built are all textbook qualifying assets. Even some inventories like wine or cheese that needs to age for a long time can qualify. But here's what's just as important. What's not a qualifying asset? Look at financial assets like shares. Big fat no. Why? Because they're ready to go the second you buy them. The same goes for any asset that's ready for use the moment you get it, like a machine you just plug in and turn on. No substantial period, no qualifying asset. Simple as that. Okay, so we know we capitalize interest on qualifying assets, but how much? To figure that out, we need to split our loans into 2 camps: specific borrowings and general borrowings. The difference is really straightforward. A specific borrowing is exactly what it sounds like, a loan you took out for one specific project, say to build that new warehouse. There's a direct one-to-one link. General borrowings are pretty much everything else. It's your general pool of funds, a big pot of money the company uses for all sorts of things, and some of that money might end up being used for a qualifying asset. The calculation for each is different, so figuring out which type of loan you're dealing with is your next crucial step. Let's start with the easy one, specific borrowings. The amount you can capitalize is the actual interest you paid on that specific loan during the period. But there's a catch.
And trust me, this shows up in exams all the time. If you got the loan money but didn't spend it all right away, and you smartly put the extra cash into a temporary investment like a fixed deposit, well, the income you earned from that has to be deducted from the interest cost. So remember the formula. It's actual interest minus any temporary investment income.
Now, general borrowings are a little more work because you can't trace the money directly, so you have to use a rate. Here's the three-step process you need to nail down. First, calculate a capitalization rate. This is just the weighted average interest rate of all your general purpose loans. Second, you take that rate and apply it to the money you spent on the qualifying asset to figure out how much interest to capitalize. And third, this is a critical safety check. The amount you just calculated can never, ever be more than the actual total interest you paid on all your general loans. It's a ceiling you can't go past.
All right, let's put on our thinking caps and tackle that super tricky topic I warned you about, the one where a lot of marks can get lost. What happens when your loan isn't in rupees, but in, say, US dollars? So if the exchange rate moves against you, you end up with an exchange loss on the loan principal. AS 16 has a very specific rule for this. It says you can treat part of this loss as a borrowing cost, but not all of it. You got to memorize this three-step process. Step 1, calculate the actual exchange loss. Step 2, figure out what the interest would have been on a similar loan in rupees, and then find the difference between that and the actual foreign interest you paid. Step 3, the amount of exchange loss you can capitalize is the lower of the two numbers you got from Step 1 and Step 2. Whatever is left over gets dealt with under AS 11. Let's make this real with the XYZ LTT example on the screen. Let's walk through it. Their foreign interest in rupees is 24,000. Now the actual exchange loss on the principal is 30,000. That's our Step 1 result. For Step 2, a similar local loan would have cost 49,500 in interest. The difference between the local interest and the foreign interest is 25,500. Now for the big decision. We compare the actual loss, 30,000, with the interest difference, 25,500. We have to pick the lower of the two, which is 25,500. So the total borrowing cost we can capitalize is the actual interest of 24,000 plus this extra 25,500 from the exchange loss. That gives us a total of 49,500. The rest of the exchange loss, that extra 4,500, goes to the P&L under AS 11. Okay, knowing how much to capitalize is half the battle. The other half is knowing when. When do you start the clock? When might you need to hit pause? And when do you stop it for good? Let's look at the timeline. The whole life cycle is pretty simple. You have commencement, which is the start. You might have a period of suspension, which is a pause. And then you have cessation, which is the end. Let's break down each one. The starting gun for capitalization only fires when all three of these things are happening at the same time. Not one, not two, but all three. You have to be spending money on the asset, you have to be paying interest on your loan, and work on the asset has to be actively in progress. So if you take a loan in April but don't start construction until June, you cannot capitalize the interest for April and May. You start from June, the day all three conditions are finally met. This is a goldmine for MCQs, so pay close attention. Now, what if work stops? Well, you hit the pause button on capitalization, but only if the work is interrupted for an extended period. If you have to stop building for a whole year to wait for a government permit, you suspend capitalization. But, and here's the classic IKI twist, if a delay is temporary and just a normal part of the process, you don't suspend. For example, building a bridge during monsoon season and having to stop for a few weeks because of high water levels, that's expected. You keep capitalizing interest during that time. That distinction is so important. And finally, when do you stop for good? You stop capitalizing when the asset is substantially complete. This doesn't mean it's perfect or every single light bulb is fitted. It means the main work is done and the asset is ready for its intended use. Minor touch-ups, like painting a wall a different color for a tenant, don't count. You've already stopped capitalizing by then. This can get a little tricky with big, complex assets. Look at this comparison. If you're building a business park with 5 separate office buildings, as soon as building A is finished and ready to be used, you stop capitalizing interest for that part, even while you're still working on the others. But for something like a steel mill, where one part can't work without the others, you have to keep capitalizing until the whole shebang is complete and ready to run as one unit. All right, the theory's done. Let's get our hands dirty and put all this into practice. We're going to apply what we've learned to solve some exam-style scenarios, starting with that problem from the very beginning. Okay, remember PRM Limited? Total loan of 120 lakhs, total interest of 18 lakhs. Let's apply our golden rule to each item. First, construction of the shed. This definitely takes a substantial period, so it's a qualifying asset? Yes. Next, the machinery. It was ready for use on the day they got it,
not a qualifying asset. Working capital, never a qualifying asset. And the truck advance? A truck is ready to use when you get it. It doesn't need a long time to prepare. So also not a qualifying asset. That means only the 50 lakhs for the shed relates to a qualifying asset. So we just need to apportion the interest. We take the total interest of 18 lakhs and multiply it by the proportion of the loan used for the shed, which is 50 out of 120. That gives us 7.5 lakhs to be capitalized. The rest of the interest, 10.5 lakhs, goes straight to the profit and loss account. See? Not so bad when you break it down.
Now for a full-blown exam-style question that has both specific and general loans. Let's break it down. The weighted average expenditure on the asset for the period is 6,225,000 rupees. We know that 1 lakh of this was funded by our specific 10% loan, so that's easy. We capitalize the full 10,000 rupees of interest from that loan. That leaves the rest of the expenditure, 5,225,000 rupees, which must have come from our general pool of funds. To figure out the interest on this part, we first calculate our capitalization rate. The weighted average rate of all our general loans comes out to be 12.285%. So we apply this rate to the expenditure, 5,225,000 rupees times 12.285% gives us 64,189. So the total interest we can capitalize is the 10,000 from the specific loan plus the 64,189 from the general loans. That's a total of 74,189 rupees. We add this amount to the cost of the building, bringing its total cost up to 10,094,189 rupees.
Just a quick but really important side note. AS16 doesn't live in a bubble. After you've done all your calculations and capitalized the borrowing costs, you still have to check if the final value of your asset is more than what you can actually get back from it. If it is, you need to write it down, following other standards like AS28 on impairment. You can't just keep adding costs to an asset if it's not actually worth that much. And for those theory questions they love to ask, what you actually have to disclose in the financial statements? It's super simple, just 2 things. 1, the accounting policy of used. Basically, you just say you follow AS16. And 2, the total amount of borrowing costs that you capitalized during that year. That's it. Nice and easy.
Let's look at one more classic trap. Take LTD, borrowed money to buy shares in another company. Their directors decided to capitalize the interest and add it to the cost of those shares. Is this okay? No way. As we talked about, shares are financial assets. They're ready to use the moment you buy them. They don't take a substantial period of time to get ready. Therefore, they are not qualifying assets, and that interest has to be expensed to the P&L. All right, you've absorbed a lot. Time for a final knowledge check. Let's run through some quick-fire MCQs to really lock in these concepts and see if you can spot the traps. Let's quickly go through the answers. Number 1, assets ready for sale are not qualifying assets. Number 2, the FX adjustment is limited to the lower of 2 amounts, so the correct answer is none of the above. Number 3, the capitalization rate is only for general borrowings. For specific loans, you use the actual interest rate. Number 4 is a great one that links AS16 and AS2. After capitalizing interest, the inventory cost is 52,000, but its net realizable value is only 45,000. AS2 says you value inventory at cost or NRV, whichever is lower. So the inventory has to be valued at 45,000, meaning you could only effectively capitalize 5,000 of the interest. And finally, number 5, commencement starts on the 19th of June, because that's the date when the third and final condition was finally met.
So at the end of the day, AS16 isn't just a set of rules and formulas. It's about judgment, deciding what a substantial period is, or figuring out when an asset is substantially complete. These things require you to think based on the specific facts of the case. And in the exam hall, it's that judgment and your ability to justify it with a clear note that will really set you apart. That's the real key to mastering AS16.